to Commercial Real Estate Now. I'm Carly Iacono. Today, we're unpacking how the new One Big Beautiful bill just signed into law could reshape commercial real estate investing for years to come. Before we jump in, a quick note. I'm not an accountant or an attorney. This is general information only. Always talk with your own advisors before making tax or legal decisions. Now on to the good news. This bill brings major tax advantages that smart investors should be planning for now. Here's an overview of the key points I'll run through today. Number one, bonus depreciation is back at 100% through 2029. Number two, 1031 like-kind exchanges are fully preserved, no new limits or changes. Number three, the qualified business income deduction is made permanent and increased to 23% for pass-through entities. Number four, a fresh wave of qualified opportunity zones creates new tax deferral and forgiveness opportunities. Five, green energy incentives remain strong with expanded accelerated depreciation for energy efficient upgrades. And finally, the carried interest loophole, it stays open, once again surviving tax reform. Okay, let's go a little deeper into what these provisions mean for investors, starting with bonus depreciation. First, let's clear up confusion about what you can actually write off under bonus depreciation. First, as you likely know, land never qualifies for depreciation, and you can't take bonus depreciation on the entire building structure that has a useful life over 20 years. The magic happens with the improvements that have a useful life of 20 years or less. Now, that usually includes things like site improvements, like parking lots, sidewalks, curbs, landscaping, etc. Interior components like flooring, lighting, and plumbing fixtures, certain mechanical systems like HVAC units, electrical upgrades, specialty equipment tied to a tenant's use, and furniture, fixtures, and equipment for commercial tenants. Think restaurant kitchens or medical exam rooms, etc. Now, to get the full benefit, owners use a cost segregation study, which breaks out these shorter life components from the main building. For example, you buy a $10 million retail center. The land is, let's say, $2 million, which can't be depreciated. The main structure is about $5 million, which depreciates over 39 years under normal rules. A cost seg study might carve out, let's say, $3 million of parking lots, interior finishes, and equipment. That entire $3 million qualifies for 100% bonus depreciation, meaning you can deduct it all in the same year the property is placed into service. So instead of slowly depreciating your entire investment, you unlock a big tax deduction upfront, improving cash flow and your return on equity. Now, moving on, I have good news for owners who rely on deferring taxes. 1031 exchanges were untouched in the new bill. Still the same identification and closing timelines, still only for like-kind business and investment properties, and still a powerful tool for trading up into higher performing assets without triggering capital gains all at once. 1031 exchanges remain one of the biggest wealth building levers in real estate. The bill also launches a new round of Qualified Opportunity Zones, or QOZs. Now let's start with how QOZs are chosen. Opportunity zones are designated low-income census tracts chosen by each state and approved by the Treasury. This is to encourage investors to redevelop underused areas like aging shopping centers or older retail corridors. Now, how do you invest? To get the tax breaks, you must invest your capital gains through a qualified opportunity fund. But this can actually be as simple as forming your own LLC or partnership, self-certifying it with the IRS, and buying or developing property within the opportunity zone. You don't have to join a big national fund. Many investors self-certified their own qualified opportunity funds to buy and improve property directly. Here are the key rules. The fund must substantially improve the property, generally by investing in an amount equal to or greater than what you paid for the building, excluding the land, within 30 months. Or it must build new property on vacant land. The investment must come from capital gains to get the deferral benefit. So what are the tax benefits exactly? Number one, deferral. You can defer tax on your original gain until December 31st, 2029 if reinvested in a QOF within 180 days. Number two is the step up. If you hold for 5 years, you get a 10% step up in basis, so you only pay tax on 90% of the original gain. Number three is the exclusion. If you hold for 10 years plus, you pay zero capital gains tax on new appreciation from the opportunity zone investment itself. So, for example, let's say you sell an old retail property with a $1 million gain. You then form your own QOF. You buy a vacant strip center in a designated opportunity zone, and you invest enough to fully renovate it within 30 months. If that new project appreciates while you hold it for 10 years plus, that new growth is tax-free. Key point, you can buy and improve property directly, but only if you self-certify your LLCs or partnership as qualified opportunity funds and follow all the rules. Otherwise, you miss out on the special tax treatment. Next, the bill also extends or enhances accelerated deductions for energy efficient upgrades, like high efficiency HVAC, solar systems, or EV charging infrastructure. For owners, these improvements can lower operating expenses, make a property more marketable to ESG-focused tenants, and deliver immediate tax benefits through bonus depreciation or Section 179 expensing. Now, combining cost segregation with green improvements really can supercharge your first-year write-offs. Finally, last but not least, carried interest stays open. Despite years of attempts to close this so-called loophole, real estate sponsors and fund managers can still treat carried interest, which is their share of a deal's profits, as long-term capital gains if they hold the asset for at least 3 years. This remains a powerful tool for syndicators and private equity players to attract investors and maximize after-tax returns. So here's the bottom line. The One Big Beautiful Bill creates a multi-year window to use 100% depreciation and cost segregation, to trade assets tax efficiently through 1031 exchanges, to tap new opportunity zones for tax deferral and forgiveness, to invest in green upgrades that boost NOI and tax savings, and for sponsors, the carried interest treatment remains untouched. Now, these tools won't last forever. Bonus depreciation is scheduled to phase out after 2029 unless extended, and opportunity zones come with tight deadlines. So talk to your CPA, legal team, and of course, quality brokers now to plan your next acquisition, improvements, and your exit strategies. If you found this episode helpful, follow Commercial Real Estate Now for more practical, actionable insights. I'm Carly Iacono. Thanks for listening, and I'll see you next time.